Where in the world should you buy real estate? The difference of buying a property in the right location versus buying in the wrong location can have a huge impact on the returns and the success of your investment. Hey there, what's going on? My name is Matt Maupin. I've been investing in alternative assets for over 20 years. I'm also the founder of the Passive Wealth Investors Club. Today we're going to be talking about how to choose a good real estate market to invest in when buying commercial multifamily properties. As always, we're here to help investors make better investment decisions, and we hope this information is valuable to you. But before we get started, go ahead and hit that like button so that you can help us grow this channel. Also, if you haven't subscribed, go ahead and do that now. That way you won't miss out on any of our brand new content that we'll be releasing in the future. So I want to start us off with a question. Have you ever heard of the 3 rules of real estate? Think about it. What are the 3 rules of real estate? Well, I've heard it's location, location, location. You probably heard that too, right? And location is tremendously important when investing in real estate. But actually, just buying a property in a good location is not going to guarantee your success. You still need to make sure that you manage it well and that the physical attributes of the property are suitable for investment. That being said, the difference of buying a property in the right location versus buying in the wrong location can have a huge impact on the returns and the success of your investment. You can have a great property and operate it well, but if the property is located in a market that doesn't perform well, your yield on that investment is going to be constrained by the poor location. The best real estate investments are made by buying the right property in the right location and operating it effectively. If you can check those 3 boxes, you're going to have yourself a successful investment. You know, what's great about commercial multifamily of scale is that you don't necessarily need to invest in your own backyard. Now, I wouldn't recommend buying 1 or 2 homes across the country, but buying a property of scale in another state can be a great investment strategy. Choosing a good market and location is important because the location is going to provide the organic growth that comes naturally from owning well-located real estate. And this organic growth should be complementary to properly managing and optimizing the property for performance. You know, right now there are so many properties for sale, but very few actual deals to be had. And I'll tell you, this business is not about buying properties. It's about uncovering deals. And hopefully this video can help you quickly narrow down your search for deals by teaching you how to identify good locations to invest in. We're going to start at a very high level and then work our way down to the street level. What makes a good market location for investment? Where in the world should you buy real estate? I want to say that the United States is the most desirable place to own real estate in the world. We enjoy property rights and liberties that most other developed countries do not share. And that's why you see so many foreign investors buying properties here. I'm not saying investing in other countries is not worth considering, but it's just not something that we'll be covering in this video. Within the US, regionally, I think it's a good idea to pay attention to the Sun Belt market. So these are states in the southern part of the US, and they enjoy warmer climates, business-friendly state governments, and a lot of positive net migration. I don't know if you've noticed, but there are a ton of people moving from New York City and LA and Chicago into into Florida, Georgia, Texas, Arizona, Arkansas, some of these states. So that's going to be your Sun Belt region. So on a state level, I think it's important to take a look at the landlord-tenant law and see if it's favorable to do business in that area. You know, we're going to be looking at regulations such as rent control. We also want to know how hard is it going to be to evict somebody if they're not paying the rent. I know I don't want to invest in an area where I'm fighting against the government just to run my business. So that's kind of how you identify a good state. Now, once you find a state that you feel like is a good state to take a look at, you'll start digging into some different cities or MSAs. And MSA just stands for Metropolitan Statistic Area. MSAs are broken down into primary, secondary, and tertiary markets. Primary markets are going to be your major markets like LA, Chicago, New York City. Population sizes over 5 million, Houston. And then you have your secondary markets. That's going to be a little bit smaller markets from 1 to 5 million people. And then your tertiary markets are going to be up to 1 million in population. As a rule of thumb, we personally do not invest in primary markets because they don't tend to be very landlord friendly. This is something to consider there. I think when we're talking about size, one thing to consider is how small is too small. In my opinion, a market is too small when it's hard to find a good management company, or if sourcing materials becomes a problem. So if you think about it, if a market doesn't have a Home Depot, how hard will it be to make repairs to a unit if when we get resident requests for repairs? You also want to consider how far away is this market from a major airport. If you have to jump on a plane for a 3-hour ride and then rent a car for a 4-hour drive, it's just something you want to consider before you really want to look at a property. We personally like secondary and tertiary markets that fit some of our other criteria. I really like focusing on markets that are growing or emerging. I'm going to give you some of the major indicators that'll help you determine if a market is actually growing. Big thing you want to look for is the population growth. That's a great indicator of household formation, and that's going to make up the rental demand side of the market. Really, you want to look for markets that have 2% or more population growth, especially over a period of at least 12 to 18 months. That's when a lot of people are moving there. You're going to have a lot of demand for rental housing. You also want to take a look at migration patterns. So U-Haul.com has a survey that they show where all their trucks are going. So people are moving, they're in a U-Haul. The survey shows where a lot of these trucks end up at. And you can see which states and which cities have the most people moving into them. Another thing you want to really look at is job growth. A good website for that is BLS.gov. That's Bureau of Labor Statistics. And you want to take a look at job growth. That's, again, an economic driver for rent growth, as well as income growth. So city-data.com. Look for at least 2% income growth historically to kind of keep up with inflation. If you can find markets that have higher than 2% historically, generally that's a good idea to look in those markets, generally speaking. You also want to keep in mind what is the supply, the pipeline for new homes coming for rent and for sale. That's basically, it's always a supply and demand thing. You should not just look at one side of that equation. You want to look at supply and also demand. Make sure they're not overbuilding in that market. That information is going to help you drill down to see, if it's a good city to invest in. But as you know, there are good parts of town, there are bad parts of town. So areas have different ratings. There's A, B, C, and D. A areas are going to be your most expensive parts of town, most expensive real estate, nicest areas. And then you have B areas are going to be maybe a little older than the nicest parts of town, but still very nice. And then you have your C areas, that's kind of your blue collar areas, but they're not high crime. And then you have your D areas at the other end of the spectrum. That's going to be, where there's high crime, maybe a lot of drug abuse. Areas I would not recommend you invest in. It's hard to keep good properties and good tenants in those areas. You don't want to work against the area. Now, if you're looking at a property across the country, how the heck do you know if it's in a good part of town or a bad part of town? First thing I would recommend is you take a look at the crime statistics. There is a good website. It's adt.com/crime. I think it's got like a heat map, and you can kind of take a look at different areas and see, what are the good parts of town, what are the bad parts of town. The second thing you're going to want to look for when determining what part of town you might want to invest in is taking a look at the schools in the area. Great website for this is greatschools.org. And they rank schools from 1 to 10. And generally, if you can find a part of town that has a lower crime and higher school ratings, generically, that's going to be a better part of town to invest in. So also, when you're looking at a city, I think it's a good idea to take a look at the economic makeup of the market. You want to be investing in markets that have solid economic diversity. A big thing you want to stay away from is markets that have single economic drivers, maybe one employer, one industry that really drives that whole economy. What happens is if something happens to that industry or that employer, maybe the employer moves, or maybe it's an oil town and cost per barrel goes down, you can have a lot of people moving out. And so that's going to literally, you can have a ghost town in a few months just because of an industry coming apart or a major employer going under. So definitely want to keep a look for economic diversity. Also, a good thing to look at is affordability. Taking a look at what portion of the average wage goes to pay the average rent. And one thing to be said here is the more affordable an area is, the more we can generally push rents after renovating the property. If it's very unaffordable, it's really hard to push rents. Even if you make huge, renovations and you're really upgrading the units, if it's not affordable, you're not going to be able to push your rents. If it's very affordable, it's a lot easier for people to justify that extra disposable income to upgrading their lifestyle. Another thing is demographics. So just taking a look at income and different things in the area. There's some paid services that you can do to find this at. Actually, city-data.com also has some of this, although it's not very localized to an area. It's kind of the overall city. You can look at little submarkets and get some of that, but you're really not going to be able to get down to the micro market unless you get to a paid service. I think it's important to note that really COVID has changed the way that people live and work. Now that people can sort of work remotely, people are choosing to move to where they want to live, maybe more affordable areas, and then work from home. And again, I mentioned a lot of people are moving, let's say, from LA to Texas or something like that. Maybe somebody could barely afford a 1-bedroom in LA, but now can get a 2-bedroom in Texas. So you also want to take a look at, within the property, the unit mix or the actual number of bedrooms. I think larger bedrooms, larger unit sizes are going to be more appealing to those people that are working from home. So once you've found, what part of town you might want to invest in, you want to take a look at what's going on in the area. So it's, if you're not investing in your own backyard or an area you're familiar with, you're going to need to have some boots on the ground, someone that can go take a look at the area. They know the area and they give you the lowdown about what's going on in different parts of town. Generally, a property manager or local business partner can help you with this. That being said, I personally believe it's better to actually visit the property yourself before you put an offer in. And if you make a blind offer, you don't see it, at least you need to take a look at it before you close on it. Once you're there, I think you really want to drive the property, drive the area. Start at the street right around surrounding the property and kind of go out in concentric circles. And things you're going to want to be looking for, positive and negative. Pay attention to any sorts of development or redevelopment in the area, anything positive happening, but also, keeping an eye for anything negative. So if you're going to live there, what would be a deterrent? Is there any noise or air pollution, smells, or any issues that might force a good tenant to not want to stay there? So think about train tracks, highways, airports, anything that's going to make a lot of noise. It's going to be hard to keep a good tenant there if they're being woken up all night long by trains throughout the night. So here's a few things that we look out for, some sweet spots that generally are really good things to find. If you can find a property in these areas, you're going to do fairly well, all things the same. One is the path of progress. So any sort of development or redevelopment in the area, that's going to be a major benefit. Any new job announcements in an area where you have an employer maybe building a factory or moving into a new area, you're going to have a lot of, say, high-paying jobs. That's a huge indicator of rental demand coming to the area. And if you can get ahead of that, you might be able to buy while prices are still maybe lower before all the new development is able to come in and accommodate all the new buyers. And you're going to have maybe a short-term housing shortage in that area. Another thing is, if you can buy the ugliest property in a good area and you can get it priced well, that's a great deal. You can improve a property. It's really hard to improve an area. So think about that. So this video really has only scratched the surface on what it takes to drill down into a location. But I hope you found it's helpful. Hopefully it's pointed you in the right direction. Just to be clear, these are all just rules of thumb. It's important to note there are good investments to be made and investments that maybe don't check all these boxes. If there's a compelling story or reason, you still may want to invest in a project. Also, I wanted to share a really good source for MSA market data. The Marcus and Millichap comes out with a national investment forecast every year, and basically they rank the top 50 MSAs, and that's a really good resource. If you have any questions about this topic or would like to see us cover another topic, please comment below and we'll do our best to accommodate you. Until next time, thanks for watching, and go out there and create some passive wealth and income. Hey, thanks so much for watching. Did you enjoy today's video? Let us know in the comments below, and be sure to tell us what else you want to see on this channel. Also, take a look at some of our other videos right here. And as always, be sure to subscribe and tell your friends about the Passive Wealth Investors channel.